Day trading is all too often sold on social medias as the best way to make money easily and quickly, but this is not the case at all. Trading can make you a lot of money, but 90% of independent traders are failing or will fail, and I am going to explain why in this video. The world of trading and finance in general is much more complex than it seems. The best engineers and statisticians work there because the salaries are huge. These people create trading terminals like the Bloomberg terminal, which are way more powerful than those in the traditional market. They have access to data that you can't find anywhere else, like stop losses, high liquidity lines. They know everything about everyone at all time in real time, and you think you can beat them because you can detect an uptrend or patterns. They are hungry for money, and they will always look for ways to make small traders look like losers. It's like fighting in the dark against people with night vision goggles. If you're lucky, you might knock one of them out, but you are not guaranteed to survive. Let's take the recent example of Elon Musk and his ambition to buy the social media Twitter. Everyone has heard about the huge gift Elon Musk wanted to give himself. Twitter was valued at the time at $44 billion, or Elon Musk obviously did not have as much cash. Indeed, it is estimated that at that time only $3 billion were available, far from the value of the social media. So he had to sell nearly 10 million Tesla shares worth $8.4 billion. But such a sale causes liquidity problems in the market. There are not enough buyers for Elon Musk to sell so many shares, and this is where it gets interesting. He has to create liquidity in the market to allow him to sell. Let's study the movement of the Tesla share price during this distributive market phase. At first sight, we see a phase of lateralization of the price with the creation of a support zone considered as important by independent traders, and it is indeed the case. The price bounces several times. Now, as we also know, the investors who bought the stock on this support logically placed a protective stop below this level. As a reminder, a stop loss is a sale to the market. Naturally, when this support was crossed, the selling liquidity present below it allowed a rapid price drop, and thus, in this phase, we have a transfer between the strong hand, the massive sale of Elon Musk, and the weak hand, the traders. So it is in this zone that Elon Musk sold a phenomenal amount of shares to buy Twitter, but it is not over. The incentive for independent traders to buy the stock is not only technical, but also fundamental. When Tesla was selling massively, the company's results were released at the same time. What could be better than positive result to encourage traders to buy when the strong hand is only looking for one thing, to sell? And it did not fail. When the announcement was published, the price is right on the support, allowing a massive purchase and a bargain sale sold for Elon. The timing is almost perfect, and it is far from being an isolated case. Almost all institutions use the same strategies. When a positive news comes out, it is very likely that some whales are already selling. The big whales, as they are called, that is to say the institution with a very large number of shares of one or more companies, will always play with human psychology in order to make small traders lose. They have access to everything. Whether it's the media, the charts, they manipulate everything in order to make traders stress and make them make bad decisions. So, it's much better to do long-term investments in stuff you understand. If you want to understand the world of finance, you need to know that the stock market has only three main phases. Accumulation, which is a stable phase where prices are rather low compared to the average and where whales buy stocks or other values little by little. Then comes the bullish trend, often triggered by a pattern or a news. Once the whales are satisfied with the resale price, they will again take advantage of news or line with high liquidity to rest on them and sell at a maximum profit. The last phase is the downtrend. It comes naturally because the selling has been too great. People often panic and decide to sell what they own, and then the cycle repeats itself. It is visible at all scales, but is much more stable on large time scales. It is then wiser to look for these phases rather than relying on patterns used to precisely trap you. But if you still want to learn day trading, you should know that your psychology will play a big role, especially if you start with real money. And above all, only use money that you are ready to lose. For more advice on trading or making money online, don't forget to subscribe so you don't miss our next videos, and see you next time.